Today we're going to talk about a hidden crack in the American economy, empty office towers and the debt stacked underneath them. Picture a normal weekday morning. The coffee shop is open, the subway runs, people still complain about emails, everything looks fine, and then you walk through the financial district at lunchtime. Half the lights are off, the lobby feels like a museum, the security guard looks bored enough to start writing a novel. That quiet is not just a vibe, it's a balance sheet problem. Because office buildings are not like homes. A home is usually a long story. 30-year mortgages, slow payments, a life unfolding. Commercial real estate is a short story with big numbers. 5 years, 7 years, 10 if you're lucky. Then the whole loan comes due. Not the interest, the whole thing. That one detail is why this topic matters. Not because office buildings are emotional. They're not. They're concrete and glass and bad carpet. It matters because those short loans create cliffs. And when enough loans hit a cliff at the same time, the economy starts doing that thing where it pretends nothing is wrong right up until it isn't pretending anymore. If you lived through 2008, you already know the feeling. It wasn't one headline that did it. It was a slow leak that suddenly became a broken dam. A lot of people remember 2008 as a bank problem, or a lemon problem, or a subprime problem. Those were the names on the front of the movie poster. The story behind the poster was real estate. Borrowers stretched too far, prices got silly, loans went bad, then the plumbing of finance backed up. Real estate has a habit of being the first domino, because it's where leverage likes to hide. A building looks solid, a deed looks official, so people borrow against it like it can't move. Then it moves. Now let's talk about the rhythm people forget. Every big financial mess feels different when you're living in it. Different villains, different excuses, different buzzwords. Then you look back and you see the same skeleton. Easy money, rising prices, borrowers get brave, lenders get relaxed, then something changes. Rates rise, growth slows, cash flow drops, refinancing gets hard, the brave become stuck, the relaxed become strict, the music stops. Some folks like to describe this as an 18-year cycle, not as magic, not as superstition, more like a human memory cycle. After a crash, everyone is cautious. Banks write tighter loans. Investors demand better deals. People talk about risk again. Then time passes. A new group enters the workforce. A new group runs the funds. A new group runs the banks. They didn't feel the last pain in their bones. They read about it. They think they understand it. They don't, so the rules loosen again. Not all at once, a little here, a little there, and by the time the cycle is ready to bite, many people genuinely believe it can't, because it hasn't in their adult life. Because the last one is a history lesson, not a scar. That's the psychology piece. Now the mechanics. Office buildings make money when people pay rent. No rent, no cash flow. No cash flow, no debt service. No debt service, you default. That part is not complicated, it's just uncomfortable. After 2020, something changed that isn't going back to how it was. Remote work didn't kill offices everywhere, but it broke the old certainty. A lot of meetings don't need a room. A lot of work doesn't need a desk downtown. A lot of companies realized they were paying for status more than function. Some firms still want offices. Some jobs need physical space. Some teams work better together in person. All true. Still, demand does not need to drop to zero to cause a crisis. It only needs to drop enough to break the math. Commercial real estate math is fragile because it's built on a few assumptions: high occupancy, stable rent, cheap refinancing, a buyer who will pay more later. When occupancy falls and rent drops, the building is worth less. When the building is worth less, the bank lends less. When the bank lends less, refinancing becomes a puzzle with missing pieces. Let me make this concrete. Imagine an office building bought for $100. The owner borrows $70 million. That's common. Maybe the interest rate was low when they borrowed, maybe they got a fixed rate. They pay interest for a few years, they plan to refinance later, now fast forward. Office demand is weaker, vacancy is up. To fill the space, the owner cuts rent, so the building's income drops. Investors value buildings mostly by income. Less income means less value. So that $100 million building might be valued at $60 million now. That changes everything. The owner still owes close to $70 million. The building is worth $6. No one wants to refinance a loan bigger than the building. A new lender might say, we'll lend 60% of value, 60% of $60 million. That doesn't pay off the old loan, not even close. So the owner has a choice: bring cash to the table, sell the building at a loss, or hand the keys to the bank and walk away. That last one is happening more than people admit. It's not always dramatic. It's often quiet. The owner stops paying. The lender takes control. The building becomes owned by a bank that never wanted to own a building. And banks are not built to be landlords. They're built to lend. They lend, they collect interest, they move on. They don't want to manage elevators and leaking pipes and empty floors. They definitely don't want to sell a bunch of distressed buildings at the same time. Because if banks all try to sell at once, prices fall harder, then more owners are underwater, then more keys get handed back. Then the bank ends up owning even more buildings. It's a loop, a bad one. Now layer on one more fact that makes this sharper. A lot of office loans made around 2020 and 2021 were fixed rate for a short period. The owner felt protected. They looked at a low rate and thought, I can survive a rough patch. And they could. For a while, that fixed rate period acts like painkillers. The injury is still there. You just don't feel it yet. The bill comes when the loan matures. Commercial loans mature fast. 5 years is common. So loans made in 2020 are rolling toward maturity around 20. And many loans have extensions that still end up clustering in that same window. People call this a maturity wall, a refinancing wall, a wave of deadlines. Here's why a wall is worse than a slow drip. If one building has trouble, a bank can work it out. Extend the loan, modify payment, pretend things will improve. If a whole city has trouble, the bank can still handle it if the rest of the portfolio is fine. If the whole system has trouble at the same time, nobody has spare capacity. Not the banks, not the insurers, not the private lenders, not the government, not the investors waiting for bargains. And the thing that triggers the fall is often not a single disaster. It's a shortage of refinancing. The building can be okay on paper. The owner can be trying. The local economy can be fine. None of that matters if the loan comes due and the money isn't available. Now let's talk about why the money might not be available. Banks are sitting in an awkward spot. They lend against commercial properties. They also hold a lot of assets sensitive to interest rates. They also depend on deposits that can leave fast. When rates rise quickly, a bank can end up holding older assets that pay low interest while new funding costs more. That squeezes them, so they get defensive. They tighten lending standards. They stop making marginal loans. They demand more collateral. They demand more equity. They price loans higher. That means fewer borrowers qualify. That means fewer buildings can refinance. That means more defaults. And when defaults rise, banks tighten even more because they're trying to survive. This is why a real estate problem becomes a credit problem. A credit problem becomes a business problem. And a business problem becomes a job problem. Because small and medium businesses live on credit. They use credit lines to buy inventory. They use loans to expand. They refinance to survive a slow season. When banks pull back, business owners get squeezed. Projects get canceled. Hiring pauses. Layoffs start. The economy slows. Then the real estate problem gets worse because tenants struggle. Again, loop. Now step back. Why does office real estate have so much weight in this story? Because office is where the demand shock has been most visible. Big vacancy, big rent pressure, big headlines. Some cities are getting hit harder than others. Downtown cores that relied on daily commuters feel it. Places with older buildings feel it. Buildings that need expensive upgrades feel it. It's not just nobody wants offices. It's nobody wants that office at that price, with that lease structure, with that renovation bill. And when a big chunk of space sits empty, it pulls down the whole pricing structure. Tenants have choices. Landlords compete. Rent drops. That sounds like a normal market until you remember the debt. Debt does not adjust politely. Debt is a fixed number with a due date. Rent can fall 10% and the building might still survive. Rent can fall 30% and now the owner is paying the bank with money that doesn't exist. Now you might be thinking something reasonable. If this is real, why hasn't the whole thing already collapsed? Good question. And the uncomfortable answer is timing. Financial stress can sit in the system for longer than you expect, especially when people have ways to delay the reckoning. Extend the loan, restructure the payments, use cash reserves, sell another asset, negotiate with the bank, offer to pay down a portion. All of that buys time. Time is the key word. Time is what turns a slow leak into a sudden break. Because time is what takes you from I can cover this to I have to refinance now. That's why the maturity wall matters so much. A building can limp along for months, even years, paying a low fixed rate, keeping the lights on, filling some space, cutting costs. Then the loan matures, and the world asks a simple question. Can you replace this cheap debt with new debt? And the new debt is not cheap. That's the other half of the squeeze. When rates were near zero, money was easy. You could borrow with confidence, even with thin cash flow, even with optimistic assumptions, because your cost of debt was low. When rates rise, the cost of debt rises. That changes cap rates. It changes valuations. It changes what deals make sense. It changes everything. So the building gets valued lower at the same time the debt gets more expensive. That is the nightmare combo. Lower value, higher rate, short maturity. Now we're going to get into the part that sounds like a boring technical detail, but it matters more than most headlines. Central banks influence short-term rates. The overnight rate, the rate banks charge each other for very short windows. Commercial real estate refinancing is often priced off longer-term rates. 5-year, 7-year, 10-year, and those are influenced by market supply and demand for money, plus risk premiums. If lenders think commercial real estate is risky, they demand a bigger premium. Even if the central bank trims short-term rates later, long-term commercial borrowing can stay expensive if lenders are scared and capital is scarce. So you can end up in a weird world where people hear rate cuts and assume relief is coming, while the part of the market that needs refinancing most is still paying up. That mismatch is where a lot of investors get confused. Now let's zoom into another plumbing piece that influences how much money flows into mortgages. Mortgage-backed securities, or MBS, are basically bundles of mortgage loans that get packaged and sold to investors. Banks make loans, then often sell them as securities, getting cash back so they can make more loans. That's how lending scales. It's not just bank deposits, it's capital markets. When demand for those securities is strong, banks can lend more. When demand dries up, banks get stuck holding loans and lending slows. Central banks have been major buyers of these securities at different times. When they buy a lot, it supports the market. It supports liquidity. It supports mortgage lending. When they stop buying or reduce their holdings, that support fades. Now combine all of this with bank behavior. If banks are stressed and worried, they lend less. If investors are worried, they buy fewer mortgage securities. If big buyers step away, liquidity drops. Less liquidity means fewer refinancing options. Fewer options mean more forced outcomes, distressed sales, defaults, key handbacks. This is not doom poetry, it's mechanics. Now let's make it personal, because this channel is not just about charts. On the passive path, we care about the way money problems show up in regular life. Most people watching this are not buying office towers. You're not negotiating a $70 million refinance. You're not flying to New York to tour a building. So how does this reach you? It reaches you through jobs. It reaches you through credit. It reaches you through markets. It reaches you through prices. When banks tighten, it's not only office owners who feel it, it's the restaurant owner who wants a loan to expand. It's the contractor who needs credit to buy materials. It's the startup that needs a line of credit to survive a slow quarter. It's the family that wants to refinance a mortgage. It's the person who wants to buy a car. And when businesses can't borrow, they cut spending. When they cut spending, they cut hiring. When they cut hiring, layoffs rise. When layoffs rise, people spend less. Then businesses earn less. Then more businesses struggle. This is how a commercial real estate problem becomes a normal person problem. Now I want to slow down and tell you a quick story. A friend of mine runs a small business. Not in real estate, not in finance, just a normal operation with real customers. They were doing fine. Not rich, not struggling. Stable. Then their bank called and said their credit terms were changing. Nothing dramatic in the news. No recession headline. Just a quiet tightening. Higher interest. Lower credit limit. More paperwork. It didn't kill the business. It just forced decisions. Delay hiring. Delay equipment upgrades. Cut back on inventory. Play defense. Multiply that by thousands of businesses. Now you have an economy that feels like it's walking on wet sand. It still moves. It just moves slower. And when the economy moves slower, weak parts break first. Commercial real estate is a weak part right now. So what does a smart person do with this information? Not panic, not binge watch crash predictions, not sit in cash for 10 years out of fear. A smart person prepares like an adult. Preparation is boring. That's why almost nobody does it. Then when the storm hits, they call it bad luck. Preparation looks like this. 1. Get your own house in order, not the house you live in. Your financial house. If layoffs rise, you want breathing room, cash reserves, lower fixed expenses, less debt that can choke you. If you have high-interest consumer debt, that is a guaranteed drag. Paying it down is like buying yourself flexibility. Flexibility is priceless in a tightening cycle. 2. Be careful with leverage. Leverage feels like genius in good times. In bad times, it turns normal problems into disasters. If you invest with a plan that assumes the world can get messy. A portfolio that only works if everything goes right is not a plan, it's a wish. 3. Don't confuse headlines with reality. Markets can rally while the real economy struggles. The real economy can look fine while credit is cracking underneath. Watch the boring things: loan delinquencies, bank lending lends, vacancy rates, refinancing volumes. Not for entertainment, for awareness. 4. Understand opportunity. Crashes and stress create bargains. They also create traps. A cheap asset is not a good asset if the cash flow is broken. A low price is not a deal if the debt terms are brutal. The people who do well in downturns usually have 2 traits. They have liquidity, and they have patience. Liquidity means cash or access to stable funding. Patience means they don't rush into the first sale they see. Back in 2008 and 2009, a lot of people wanted to buy the dip. Many of them bought too early, not because they were dumb, because they underestimated how long the unwind can take. The unwind in commercial real estate can take years. Leases are long, renovations are slow, transactions are slow. Banks take time to admit losses. Owners take time to surrender. Prices take time to find a bottom. So if you're thinking in terms of opportunity, think in terms of time. Not a single week, not a single month, a window of years. Now you might be thinking, okay, but the government will step in, right? Maybe. Sometimes. In some form. With trade-offs. When systems are under stress, policymakers tend to choose between 2 ugly options. Let failures happen and risk a deeper recession, or step in and risk more inflation and more distortion. They rarely get a clean win. That's why relying on rescue is not a personal strategy. It's a bet on politics. Your strategy is your balance sheet, your skill, your resilience. I'm going to say something that sounds simple, and it is. It's also hard. Your best defense against a messy economy is control over your own life. Skills that make you employable, savings that give you choices, low expenses that reduce fear, diversified income when possible, a mindset that doesn't fall apart when the news gets loud. That's the real passive path. Not laziness, not magic. A life built so you don't have to panic. Now let's go back to the 18-year idea for a moment. If you treat it like prophecy, you miss the point. The point is not that a calendar date causes collapse. The point is that cycles create patterns because humans create patterns. Credit expands, credit contracts, memory fades, risk returns. So instead of worshiping a number, use it like a reminder. People forget. You don't have to. If we are heading into a period where a lot of commercial loans mature and a lot of those properties are weaker and lenders are tighter and rates are higher, then the odds of stress rise. That doesn't mean a crash is guaranteed. It means preparation is rational. Now let's talk about what stress can look like, because it's not always a dramatic stock market collapse. Stress can look like a wave of quiet defaults in office buildings, banks taking losses, more bank failures or forced mergers, less lending, a slower economy, higher unemployment, weak consumer spending, pressure on small businesses. In markets, stress can look like volatility, sharp moves, everything is fine, rallies followed by ugly drops, people chasing narratives because reality feels boring. In daily life, stress can look like hiring freezes, reduced bonuses, longer job searches, tougher loan approvals, higher insurance costs, higher rent in some segments, even if offices are empty. Because different markets behave differently. And that last point matters. Office can collapse while housing stays expensive. That sounds wrong until you remember they're different products with different demand and different financing. So don't assume one chart explains everything. Now I want to give you a simple mental model for the next couple years. Think of commercial real estate as a building with 3 floors. Floor 1 is cash flow, occupancy, and rent. That floor is already shaky in many places. Floor 2 is debt terms, interest rates, and maturity. That floor is changing fast. Floor 3 is refinancing availability, the willingness of banks and markets to provide new loans. That floor can disappear suddenly if fear spreads. If all 3 floors weaken at once, the building collapses. If only one weakens, the system can patch it. Right now, cash flow is weak in a lot of office assets. Debt terms are worse than a few years ago. Refinancing availability is tightening. That's why people are paying attention. Now let's shift into the part that matters most for your actual life. What do you do with this? In practical terms, without turning into a paranoid squirrel hoarding canned beans. Start with your timeline. If you have big life moves coming up, like buying a home, changing jobs, starting a business, taking on debt, think like a risk manager. Not scared, just aware. Ask yourself, if the economy got tougher for 12 months, would I be okay? If my income dropped, would my bills still get paid? If my job search took longer than expected, would I have runway? If the answer is no, your first investment is stability. Emergency savings, debt reduction, budget cleanup, boring, powerful. Next, think about concentration. If your income comes from one employer in one industry, you're more exposed. You can't always fix that quickly. Still, you can offset it over time. Skills, side income, networking, being the person who can solve messy problems. In downturns, the people who survive are rarely the ones with perfect resumes. They're the ones who can be useful fast. Now, if you invest, keep it simple. You don't need to predict the exact month a crisis hits. You don't need to bet on a single asset collapsing. You don't need to become a doomsday trader. You need a portfolio that can handle surprises. Diversification is not a vibe. It's a defense, a mix of assets, a plan for rebalancing, a long horizon, some liquidity if opportunities show up. No forced selling. Forced selling is the killer. It's what turns a normal dip into permanent loss. That's why the real game is not returns. It's staying in the game. Now, I want to say one more thing before we move on. When people talk about crashes, they often talk like the whole world goes dark. That's not how it feels from inside. From inside, it feels like confusion, mixed signals. Some people doing fine, some people struggling, some industries booming while others bleed. So when you see headlines, remember this: the economy is not one thing, it's millions of stories. The commercial real estate story might be ugly. Your story can still be strong if you build it that way. Keep that in your pocket. Now let's walk deeper into the 2025 to 2027 window and why it keeps showing up in conversations. Because this is where the maturity wall meets the new cost of money. If you borrowed at 2 to 3% and now refinancing is closer to 6 or 7%, your interest expense can more than double. Even if your rent stayed the same, that hurts. If your rent dropped, that can kill you. If your building value dropped, that can trap you. Owners who can write a big check might survive. Owners who can renegotiate might survive. Owners who can convert buildings to new uses might survive, though that's harder than it sounds. Owners who are already strained will fold, and when enough fold, the lenders feel it. That's where we pick up next. Banks that take enough losses stop behaving like growth engines. They behave like wounded animals. They protect themselves. That's when credit tightens for everyone. Now imagine this happening while government budgets are strained too. Property taxes often fund cities. When commercial property values fall, tax revenue can fall. Cities then cut services or raise taxes elsewhere or borrow more. None of those are painless. So a commercial real estate downturn is not only about landlords and banks, it hits city finances, employment, and local business ecosystems. An office tower supports a lot of invisible jobs: cleaning crews, maintenance, security, coffee shops, lunch spots, transit ridership, suppliers, contractors, even the people who repair the elevators nobody wants to think about until they stop working. When a tower empties, that web weakens. Now connect that to consumer behavior. When people feel uncertain, they cut spending, they delay travel, they delay big purchases. They stop upgrading phones and cars, they cook at home more. That's not bad behavior, it's human. Businesses then see lower revenue. They cut back, they hire less, they lay off, then unemployment rises. Then spending drops more, the loop tightens. If this feels familiar, it should. This is how financial problems spread. Not because everyone is directly exposed, because everyone is connected. Now let's deal with a common misconception. People hear commercial real estate and imagine it's all giant banks and billionaire landlords. They assume pain is isolated at the top. That's like thinking a broken engine only affects the mechanic. You're still in the car. Commercial real estate debt is held by banks, insurance companies, pension funds, and investors who buy loan products. Losses can ripple through portfolios that affect retirement accounts and credit availability. Again, it's not a neat, isolated event. Now let's talk about the Fed will save us idea with a calm head. Central banks can add liquidity. They can cut short-term rates. They can create facilities to stabilize funding markets. They can encourage confidence. They can't magically refill an empty office building. They can't force tenants to sign leases. They can't force companies to return to a 5-day commute. They can't undo a bad purchase price. They can slow the bleeding. They can prevent a system-wide panic. They can buy time. Time helps if the underlying cash flows recover. Time is useless if the underlying cash flows don't recover. That's why office is tricky. Some buildings may not recover the old demand at the old price, not because the economy is broken, because behavior changed. So the best case outcome for many office assets might be a long grinding reset. Prices fall, debt restructures, new owners buy at lower valuations. Rents stabilize at a new level. Uses shift over time. That's not instant crisis, it's slow pain. Slow pain can still cause sharp moments, especially when refinancing deadlines hit, but the long story might be drawn out. Now, if you're a regular investor, this matters in a few ways. 1, market narratives can swing hard. People will blame and credit the wrong things. They always do. 2, certain sectors can get hit. Regional banks, real estate investment trusts that own office properties, construction and related services, local businesses in office-heavy downtowns. 3, fear can create bargains, but only for people who can wait. If you are investing for the long term, your job is not to call the exact bottom. It's to avoid doing something stupid under stress. The stupid stuff usually looks like selling everything after it already fell, taking on high-interest debt because you're behind, buying a cheap asset with hidden refinancing risk, chasing a hot trade because everyone is yelling. Staying calm is a financial advantage. It sounds like a poster. It's real. Now I'm going to give you a simple checklist you can run without turning this into a full-time hobby. First, personal runway. How many months could you cover your essentials with savings if income dropped? If the answer is less than 3 months, start there. If it's 3 to 6, better. If it's more, you have options. Second, debt fragility. Do you have debt with variable rates or short reset periods? Credit cards, personal loans, some adjustable mortgages, anything that can jump when rates move, those are stress multipliers. Third, job resilience, not job security as a promise. Resilience as your ability to land somewhere else. Skills, portfolio, network, proof you can do valuable work. Fourth, investing discipline. Do you have a plan you follow even when headlines are loud, or do you invest based on mood? Mood investing is expensive. Now I want to offer a different way to view this whole commercial real estate issue. It's not only a threat, it's a reminder. A reminder that cash flow matters more than stories. A reminder that short-term debt is dangerous when conditions change. A reminder that leverage is a tool, not a personality trait. A reminder that stability is a form of wealth. When people talk about getting rich, they often talk about speed, quick wins, big bets, shortcuts. Most wealth is built like a bridge, slow, sturdy, designed to handle storms. That's the passive path. Now let's talk about the global angle, because people outside the US often assume American problems stay in America. They don't. The US financial system is deeply connected to global markets. If American banks tighten, global credit conditions can tighten. If markets get volatile, global portfolios react. If the dollar strengthens in a panic, emerging markets can feel pressure. If trade slows, supply chains shift. In 2008, plenty of people in places far from Wall Street still felt the shock, not because they owned US mortgages, because companies cut jobs. Investments fell, confidence dropped, so even if you never step foot in an American office tower, the ripple can reach you. Now let's be fair, there are scenarios where this doesn't explode, there are scenarios where it stays contained. Banks have already been adjusting, some loans have been written down, some buildings have been recapitalized, some owners have sold early, some lenders have extended terms to avoid fire sales. That is real. The point is not guaranteed collapse. The point is a known stress point that can turn into a broader problem. If you treat it like a sure bet, you'll get reckless. If you ignore it completely, you'll get blindsided. The middle path is awareness plus preparation. Now I want to talk about a phrase that keeps showing up in financial history: return of risk. In good times, people price risk too cheaply, they lend too easily. They assume growth will rescue every decision. Then risk returns, not as punishment, as reality. When risk returns, it doesn't ask permission. It just reveals which deals were held together by cheap money. Office real estate has a lot of deals held together by cheap money. That's why people are watching it. Now, if you want one simple image to remember, use this. Commercial real estate right now is like a big ship with a slow leak. The crew has pumps. They've been pumping water out. They can keep it afloat for a while. The danger is when the ship reaches a storm at the same time the pumps wear out. The storm is the refinancing wall. The pump wear out is tighter lending and higher rates. If both hit together, the leak becomes a crisis. So the question is not, is there a leak? There is. The question is, how bad is the storm and how tired are the pumps? That's the game. And your personal game is simpler. You don't control the storm. You control your boat. You control your savings. You control your debt. You control your spending. You control your skills. You control your patience. Now, one last thing that people miss. When stress shows up, media attention tends to chase drama. They focus on one bank failure, one big default, one famous building selling for a shocking discount. Those are symptoms. The core is a shift in cash flow and refinancing conditions. So if you're paying attention, pay attention to the quiet numbers, vacancy and rent trends, delinquency trends, lending standards, refinancing volumes, not for entertainment, for context. Because if you have context, you can stay calm. And if you stay calm, you can make good decisions while others make emotional ones. That's not just good finance. That's a good life. Now let's bring this home with a simple, practical mindset for the next couple years. Assume the economy can be uneven. Assume hiring can slow. Assume markets can swing. Assume some assets can reprice lower. Assume opportunities can show up. Then build a plan that works in that world. A plan that doesn't rely on perfect timing. A plan that doesn't rely on easy credit. A plan that doesn't break if one year is tough. If you do that, you won't need to fear the next cycle. You'll be ready for it. And if it turns out milder than expected, you still win, because your life is still more stable. Your finances are still cleaner. Your options are still wider. That's a win either way. So here's the real takeaway. Office buildings aren't just empty buildings, they're debt contracts with deadlines. And when enough of those deadlines hit at the same time while refinancing is expensive and lenders are cautious, you don't need a dramatic headline to get real damage. You just need the math to stop working. But you don't have to fear it, because your advantage isn't predicting the exact moment something breaks. Your advantage is building a life that doesn't break with it. Keep your expenses sane, keep your cash buffer real, keep your skills sharp, avoid fragile debt. Stay patient when the crowd gets emotional. That's the passive path. Quiet preparation, strong position, and calm decisions when everyone else is sprinting in circles. If this helped you see the bigger picture, please hit like. It tells YouTube this kind of practical, calm money talk matters. Subscribe for more videos on building wealth with less stress and more control. And comment below. Do you think commercial real estate becomes a bigger crisis or just as a grind? And what's one thing you're doing this year to make your finances more resilient? Also, share this video with someone you care about, not to scare them, just to help them prepare. I'm wishing you luck. Seriously. Keep building, keep learning, keep moving forward. And if you want more, feel free to watch another video on the passive path. There's plenty here to help you stay steady in messy times. See you in the next video.